Welcome back to the Deep Dive. It is Wednesday, January 28, 2026. Today, we're putting a company under the microscope that most people never think about. Yet it arguably controls the weather in the global financial markets. We are talking about MSCI.
It's good to be here. And that's really not an exaggeration. You can think of MSCI as like the operating system for modern capitalism. They don't buy the stocks. They write the code that decides which stocks get bought.
That is a big claim. But if you're a listener with a 401k, a pension, or an ETF in your portfolio, there's a near 100% chance MSCI's data is the invisible architecture holding that portfolio together.
Yeah.
Now, they just dropped their fourth quarter and full year 2025 results today. And I have to say, looking at this print, it's a little confusing.
Confusing how?
Well, usually earnings are a simple story, right? But here, the headlines are screaming double-digit growth, revenues hitting record highs. But then I look at the bottom line, the actual cash they took home. And in the quarter, it's down. Revenue up, income down. It feels like a contradiction.
It does look like a paradox at first glance, but that contradiction is actually the perfect entry point to understand how this business really works. What we're seeing is a clash between, accounting noise and operational brute force.
Operational brute force. I like that.
It fits. I mean, we are looking at a machine that has managed to pull off its 11th straight year of double-digit adjusted EPS growth.
Wow.
Think about the last 11 years, pandemics, inflation, geopolitical crises, and this machine just keeps printing growth.
So our mission today is to figure out how the machine works and whether that headline paradox is a warning light or, just a speed bump. I want to start with the top line, the raw money coming in the door.
Let's do it. So looking at the source material, in the fourth quarter of 2025, MSCI's operating revenues hit $822.5 million.
Okay.
That's a 10.6% jump compared to the same time last year. And if you zoom out to the full year, they crossed the $3.1 billion mark.
Okay, but in the software world, companies can buy growth, right? They just acquire a competitor and add their revenue to the pile. Is that what's happening here?
Yeah, that is the critical question, and the answer is no. The report specifies that organic operating revenue growth was 10.2%. That means the core business selling data, selling indexes, selling risk tools, it's growing on its own steam. They aren't just stitching together acquisitions to hide a slowdown.
So the business is healthy. The customers are paying more. But then we hit that stumbling block I mentioned. Net income for the quarter fell 6.8% to $284.7 million. And earnings per share EPS is down 2.3% to $3.81. If I'm a casual investor, I see EPS down and I'm hitting the sell button.
And that is why we do the deep dive. You have to read the footnotes. If you scroll down to the income taxes section of the financial tables, the culprit is staring right at you. The effective tax rate for the quarter jumped to 26.8%.
That seems incredibly high for a multinational tech company. Last year it was, 15%?
15.9%. So their tax bill basically doubled overnight.
Why? Did the government change the laws?
No, this was self-inflicted, but in a strategic way. They cite a discrete tax expense related to an internal legal entity restructuring.
Translate that for me.
They're moving the boxes around inside the corporate org chart. Maybe moving intellectual property from one country to another or consolidating subsidiaries. That paperwork triggered a one-time tax hit of about $38 million this quarter.
So it's a paperwork expense. It's not that customers are leaving or servers got more expensive.
Exactly. It's a frictional cost of reorganizing the house. And here is the key takeaway. Because they took this hit now, the analysis in the report notes that MSCI expects a discrete tax benefit of approximately $88 million in 2026.
Oh, I see. So they paid $38 million now to save $88 million later.
Roughly speaking, yes. It's an investment in tax efficiency. So if you strip out that one-time noise and you look at the adjusted numbers, the picture just completely flips. Adjusted EPS for the quarter is actually $4.66, up 11.5%.
And there it is. There's that double-digit growth streak kept alive.
It's the number Wall Street actually cares about. CEO Henry Fernandez specifically called this out. Consistency is the most valuable currency in the market, and hitting that 11th straight year creates a kind of halo effect around the stock.
Okay, mystery solved. The income drop is just tax maneuvering. Now, let's open up the hood, because when I look at the revenue mix, this isn't a balanced diet. One segment is doing all the heavy lifting.
You mean the index business?
The heavyweight champion.
Yeah.
Index revenue was $479.1 million for the quarter, up 14%. That is nearly 60% of their total revenue from just this one segment.
It is the crown jewel. But we need to explain why it prints so much money. It's not just that they're selling more subscriptions.
Right? I underlined a specific line item, asset-based fees. These surged 20.7%. That sounds huge. But what exactly is an asset-based fee in this context?
Okay, think of it as a royalty on the success of the global stock market. MSCI creates a ruler, let's say the MSCI World Index. Then a company like BlackRock or Vanguard builds a massive bucket, an ETF, that holds exactly the stocks on that ruler.
Okay.
Every time you or I buy a share of that ETF, the bucket gets bigger. The assets under management, or AUM, goes up. And MSCI charges a tiny, tiny percentage of that total bucket size.
So they don't just get paid once for creating the index, they get paid continuously based on how much money is sitting in the funds using the index.
Precisely. It is the ultimate scalable model. If the stock market goes up 10%, the value of the assets in the ETF goes up 10%, and MSCI's fee goes up 10%, and they didn't have to do a single extra minute of work.
That's incredible operating leverage.
It's operating leverage on steroids. And right now, the traffic on that highway is record-breaking. The report explicitly cites record inflows into ETF products linked to our indexes.
Right.
The whole world is moving from active stock picking to passive indexing, and MSCI owns the toll booth.
But is it just the vanilla indexes, like just the S&P 500 or the MSCI World? Or are people getting fancier?
Oh, they're getting much fancier. The report notes growth in market cap-weighted products, which are the standard ones, but also significant traction in custom indexes. This is where a big pension fund comes to MSCI and says, I want the world index, but remove all the tobacco companies and overweight companies with female CEOs.
So bespoke suits instead of off the rack.
Exactly, and that commands a premium. The run rate, which is the annualized value of their recurring contracts, is up 16.2% in the index segment alone. They're locking in nearly $2 billion a year just from this.
That is staggering. But it also makes me nervous. If 60% of the revenue is from indexes and a huge chunk of that is asset-based, what happens if the market crashes?
That is the risk. It's the double-edged sword. If the market drops 20%, their asset-based fees drop 20%. They are absolutely tethered to the health of the market. However, they do hedge that downside risk with their subscription businesses.
Which brings us to the other pillars. They have ink in the name. They aren't just an index shop. Let's talk about analytics. This is the risk management software risk metrics.
This is the defensive side of the business. Revenue here is up 5.5% to about $182 million.
5.5% is fine. It's not the 14% rocket ship of the index segment. It feels a bit like a utility.
But utilities are reliable, right? The key metric here is retention. For analytics, total retention is 93.7%.
Which implies that once a bank installs this software, they almost never rip it out.
Think about the switching costs. If you are a global bank using MSCI's software to calculate your risk exposure every single night for regulators, ripping that system out is a complete nightmare. It takes years. It costs millions. You have to retrain your entire staff. So you just keep paying the subscription. It's incredibly sticky.
Sticky is good. Now, what about the segment that was supposed to be the next big thing? Sustainability and climate. A few years ago, ESG was all anyone talked about. Now the political winds have shifted a bit.
Right.
Is that bubble bursting?
Bursting. No, but it is definitely deflating to a more realistic size. Revenue for sustainability and climate is up 5.9% to $90.3 million.
That feels slow compared to the hype we saw in, 2022.
It is slower than the boom years, but the nuance is in the geography. The expert commentary highlights that growth here is primarily attributable to EMEA, that's Europe, the Middle East, and Africa.
Why EMEA?
Regulation, the Brussels effect. Europe has the strictest climate disclosure laws in the world. If you're a European company or an American company doing business in Europe, you must report this data. You don't have a choice. So you buy MSCI's product to stay out of trouble.
So in the U.S., where it's become a political football, growth is softer. But in Europe, it's basically a compliance tax.
Exactly. It's moved from nice to have to must have for compliance. And notice, the run rate for this segment is up 10%. That's growing faster than the current revenue, which tells me sales are actually reaccelerating. They're betting that regulation will eventually catch up everywhere else, too.
Okay, let's hit the final segment quickly. All other private assets. This feels like the new frontier.
It is the holy grail of financial data. Revenue is up 8.4% to about $71 million. This covers things like private equity and real estate.
Why is this the holy grail?
Because the public market is transparent. We know exactly what Apple is worth every second of the day. But what is a skyscraper in Tokyo worth? What is a stake in a private software company worth?
It's opaque.
It's incredibly opaque. And where there is opacity, there is profit for the person who brings the light. MSCI wants to be the standard appraiser for the private world. If they can become the common language there, that's a massive runway for growth.
So we have the index beast providing the growth and these other segments providing stability and future options. But I want to go back to something you said about efficiency. We saw revenue growing, but we also saw headcount growing.
Yes, total employees are up 2.2% to just over 6,200.
But look at where they are. This really stood out to me. The report breaks it down. 29% are in developed market locations and 71% are in emerging market locations.
That is a startling number, isn't it? Nearly 3/4 of their workforce is in places like India, Manila, or Monterey.
It's a deliberate strategy.
It's margin preservation. They keep the high-cost strategy roles, the people inventing the new indexes in New York and London. But the data processing, the coding, the research support, that is all being scaled in lower-cost jurisdictions.
And that explains the profitability. I mean, look at these margins. Adjusted EBIT margin is 62.2%.
Let's just pause on that. 62.2%. For every dollar of revenue they bring in, they keep 62 cents as operating profit. That is rarefied air. That's better than almost any software company you can name.
It's a cash printing machine. Free cash flow for the quarter is up 17.8% to nearly $465 million, which brings us to my favorite part of the story, the shopping spree. What do they do with $500 million of cash every quarter?
They don't hoard it. They give it back to shareholders. The capital allocation strategy here is incredibly aggressive.
Let's talk buybacks.
In the full year 2025, MSCI repurchased $2.47 billion worth of their own shares.
$2.5 billion. That's almost their entire annual revenue just spent buying their own stock.
Yep. They bought back over 4.4 million shares at an average price of roughly $560.
So this goes back to the EPS growth, right? This helps juice it.
It's financial engineering 101. If you reduce the number of slices in the pizza, the remaining slices get bigger. The total share count is down 4.7% year over year. So even if their net incomes stayed flat, their earnings per share would go up almost 5% just from the buybacks.
And they pay a dividend on top of that.
They just raised it by nearly 14%. It's now $2.05 per share per quarter.
So high growth, high margins, massive buybacks, rising dividends. Is there a catch? This sounds too perfect. Are they funding this with a credit card?
They are using leverage. The report shows $6.2 billion in total debt.
$6.2 billion. That's a big number.
It is. Their leverage ratio is 3.3 times their adjusted EBITDA.
In the corporate world, isn't anything over 3 getting into the yellow zone?
For a manufacturing company, yes. For a recurring revenue software business with 93% retention, no. It's aggressive, but it's calculated. Their target range is 3 to 3.5 times. So they are right in the sweet spot. They are essentially using cheap debt to buy back their own stock, which amplifies the returns for equity holders.
It works until it doesn't. If interest rates spike or the business slows down, that debt becomes a heavy backpack.
Correct. But for now, the cash flow covers the interest payments very easily.
So looking ahead, we're in January 2026. What does the guidance say for the rest of this year?
The 2026 guidance is projecting free cash flow between $1.47 and $1.53 billion. They expect to keep margins pretty steady, but the CEO, Henry Fernandez, dropped the obligatory magic word in his commentary.
Let me guess. AI.
You got it. He said MSCI is well-positioned to benefit from AI and use it to increase the value of our solutions.
I feel like I hear that on every earnings call. We are an AI company now. Is this real for them or is it just buzzword bingo?
You know, for a data company, it's actually real. Think about what MSCI does. They ingest oceans of messy data climate reports, private company financials, chaotic market signals. AI is the perfect tool for cleaning and structuring all of that data.
So AI could replace a lot of the manual grunt work.
Exactly. Remember those thousands of employees in emerging markets? If AI makes them 40% more efficient, MSCI's margins could go even higher. They want to be the intelligence layer of investing. AI lets them serve insights faster and cheaper.
It solidifies the moat. If they have the best data and the best AI to process it, it's hard for a startup to catch them.
That is the bet.
So let's pull this all together. We've covered tax structures, ETF flows, and global labor arbitrage. If you had to summarize the MSCI story for Q4 2025 in one sentence, what is it?
I would say it's a story of resilience through architecture.
Unpack that.
They've built the architecture of the financial system. They benefit when the market goes up via asset-based fees. They're protected when the market gets volatile because clients need their risk tools. And they have structured their costs, both taxes and labor, to maximize every single drop of profit, which they then hand right back to shareholders.
It's a fortress.
It's a very profitable fortress.
But, as always on the deep dive, we need to leave you, the listener, with a provocative thought. Something to chew on.
Here's the question I'm asking myself. We see a company with high debt, aggressive buybacks, and a workforce heavily shifted to low-cost centers. They are optimized for financial efficiency perfectly.
Okay.
But are they innovating? Is the growth coming from brilliant new products, or is it just coming from the fact that the stock market went up and people bought more ETFs?
That's the beta versus alpha question.
Yeah.
Are they generating alpha value they created themselves? Or are they just a leveraged bet on beta of the market itself?
Exactly. If the trend toward passive investing ever stalls, or if the global markets enter a lost decade of flat returns, that double-digit growth engine runs out of fuel very, very quickly.
They are surfing a massive wave. And they are surfing it beautifully, but they aren't the ocean.
Correct. They are the ocean.
A fascinating look at the plumbing of our portfolios. That's all for today's deep dive into MSCI. Thanks for listening, and we'll see you next time.